So the economics team has been watching financial markets this year to help guide our forecast. We've seen a lot of volatility and obviously a pretty rocky period to start the year for both equities and for the bond market. And probably one of the most telling, most significant things we've seen in financial markets this year has been a big plunge in long-term interest rates across a lot of the developed world. And this kind of comes on the back of most central banks easing off on monetary policy as the global economy has slowed. So the Federal Reserve came out and cut rates 3 times this year. Looking forward, we think that they probably are done with respect to rate cuts. And in fact, we don't see the Federal Reserve moving at all right through the end of 2020. We think that those changes to interest rates to date are probably going to be enough to support the economy. And we think that the Fed is going to let those policy changes work and help pick up growth over the course of the next year or so. In Canada, it's a pretty similar situation in that we don't see the Bank of Canada moving on rates right through the end of 2020. A little bit different in that they're one of the only central banks that really hasn't moved within the last year and a half or so. And the Bank of Canada has kind of just sat on the sidelines while most other central banks have cut interest rates. And fundamentally, a few reasons why. One is that the Bank of Canada already kind of sees interest rates as relatively low to begin with. So interest rates are below where they think neutral should be. They're below the rate of inflation. And they think that is stimulative enough for an economy that has slowed down a little bit. The other factor is that inflation in Canada is just higher than it is in the US. It's right around 2%. It's right where the Bank of Canada wants it to be longer term. And we don't think that there's a compelling reason for the bank to move from that perspective. And then the last one is that if you remember what happened back in 2015 when the Bank of Canada came out and cut rates twice, really set off an acceleration in housing markets in Vancouver and Toronto. And we don't think the Bank of Canada wants to go down that road again. We think the bank sees household credit and housing activity as behaving roughly the way it wants it to right now. So all those factors combined kind of suggest the Bank of Canada is more or less going to just sit on its hands right through the course of 2020, not move interest rates either way. And then for the Canadian dollar, there are 2 fundamental drivers of the Canadian dollar: interest rates relative to those in the US, both of which are expected to be stable over the next year, and oil prices. And we also expect oil prices to be pretty stable around current levels through the next year or so. And so when you combine those factors, we have a Canadian dollar that's more or less moving sideways, pretty well range bound between 75 to 77 US cents going forward over the next year or so. More or less a pretty stable environment for both interest rates and the currency.